I'm also an investment professional in the digital infrastructure space, such as yourselves, and I'm really glad to be here with you all today to learn from each other and to share ideas. Now, I usually look at things from the perspective of emerging markets, and I'm really interested to hear what our next panelists and speakers will share about changes in their market. So, the era of free cash has come to an end, and financing models around digital infrastructure are dramatically shifting. We all know that access to capital is a key enabler for entrepreneurship, and that the capital invested must work for its investors. Our next panel will debate the current barriers to value creation and market competitiveness. So please, can you give a round of applause to our next chair, HSBC's Roggen.
So, for those of you that don't know me, I'm responsible for the mid-market technology franchise at HSBC and the global banking team. So that's got a kind of quite broad reach from data centers all the way through to software. So we're going to try and touch some of the more infrastructure-led elements of that today. So just to introduce the panel, I wonder if Mark, Jan, David and Simon can just give some context on their areas of coverage.
Good afternoon everybody, my name's Mark Reynolds. I'm the Head of Investor Relations at Cassava Technologies. Cassava Technologies is a digital solutions business focused in sub-Saharan Africa. We focus both in the digital infrastructure side, so we have sizable fibre infrastructure across that region of Africa. Data centres as well, we've got an ambitious growth plan to significantly increase both our megawattage and our locations across the continent. A renewable energy business which supports both of those two other segments, and also a services business, so we've a rapidly growing cloud and cybersecurity operation, a fintech business and a digital platform business. Cassava Technologies is privately owned. We have a mixture of founder shareholders, private equity and development finance institutions on the shareholder base. We also have a $620 million US dollar bond as well.
Okay, good afternoon. My name is Jan van Roggen. I work for NIBC Bank. It's originally a Dutch bank based in The Hague. We have an office here in London. I'm heading the infrastructure team and the real estate team. And we are senior financing transactions in digital infrastructure, being data centers, fiber rollouts, towers in Western Europe. And we are owned by Blackstone since 2.5 years.
Hello, I'm David Kippen. I'm the Managing Director at Cordiant Capital. Cordiant Capital is a Canadian asset manager who has both credit and equity funds focused on several verticals. Energy, agriculture, and digital infrastructure. We do both credit and equity, control equity transactions in the digital infrastructure space through Cordiant Digital Infrastructure Limited, a London listed investment trust where we raised £800 million so thus far. I lead the investment team there in looking at digital infrastructure opportunities in the mid-market space in Europe and the UK and North America.
Good afternoon, I'm Simon Rosas. I recently joined DIF to head up digital infrastructure in Europe. DIF is a core and core plus infrastructure manager that manages about 16 billion euros out of the headquarters in the Netherlands, but also with a large global presence. We do most of the traditional infrastructure verticals, but in the digital space in particular, we are focused primarily on fiber and data centers. We own a number of fiber operators in North America and Europe, and in the data center space today we're primarily present in North America, but also looking to increase our presence here in Europe.
Thanks, Simon. Thanks, everyone. If I could also ask everyone just to think of some questions that you might want to ask as we go along. We'll try and make this interactive, potentially during or certainly at the end, if that's allowed. So, cutting straight to the chase, as introduced, kind of margin call is the subject heading. Cost of debt is a big question for everyone at the moment, not least just on an interest rate perspective, but also an appetite for risk. longer-term returns and risk profiles are, the subject matter of choice. It's seriously influencing both pricing and leverage ratios in the market and across various different deals across all the sectors just mentioned. I don't know if I can maybe ask Jan to start with your views and then we can work our way through the panel.
Yes, well, indeed, the risk-free money is gone. The interest rate, of course, went up. And what you saw at the beginning of the, say, Ukraine and energy crisis was that, say, prices of banks went up. So we increased our margin. If you now see after a year, I think things have a little bit settled. For in data centers, I think the margins are more or less back to the old level. Maybe a little bit higher, but not much. I think that many banks are very keen to finance data centers. And it has also everything to do that at the moment banks are maybe less keen on financing glass fiber. And normally the teams, so also for example our infrastructure team, we did a lot of glass fiber deals because there were a lot of glass fiber deals in the market. Especially in the UK now we see some issues in that market, and you see that banks are basically withholding a bit. And therefore put all their efforts into data centers. So the prices are there back. I think the prices in glass fiber are still pretty high, and also the leverage in glass fiber is lower as it used to be.
Thank you. I know, David, if you want to follow on, have you got any convergent views?
Boy, it's certainly a different environment than it was 18 months or 2 years ago, and I guess it's hard to generalize. Certainly the UK fiber sector, FTTP sector, a lot of people in the room I'm sure are involved or have looked at this sector pretty closely. It was wildly overbuilt, penetration rates never caught up. There were perverse incentives from the lenders to release more money for homes passed rather than for connections and penetration. And so that's a sector that's really, needs to be rationalized in our view, and is still overvalued with equity sponsors that, haven't yet come to the realization that we need to change the model. But I don't see there being a lot of debt availability for continued CapEx in the UK FTTP sector. The banks are now, they've really pretty much turned the spigots off as of the last few months. In other sectors, debt is available. In one of our portfolio companies, we started off a refi process 6 months ago, and we've seen the margin come back in really to more to 21, 22 levels rather than end of 22, where we were the fourth quarter of last year, and we're probably oversubscribed for that transaction now. So that's going very well. So I think it's a good credit story. So I think it really just depends on the assets in play and the markets you're in.
I think it's an interesting point in the sense that I would slightly disagree that UK has been overbuilt. I think it's been promised to be overbuilt. No one's actually just overbuilt it significantly, but certainly what we've seen is a huge rush into those segments, whether it's UK fiber, which everybody talks about, Germany was no better in some ways, and many of the other larger markets. Everybody was being asked the question, why are you not there a few years ago, and in particular people that weren't specialized in this segment were piling in. And now it's almost the opposite question is why are you there? And people are trying to rush out, the banks are obviously doing that as well. I think what we're seeing is a fundamental, it's not a question of pricing on the margins, it's availability of credit. But also from our own perspective as investors, we're questioning ourselves, do we need credit in some of these stories where really it's an equity risk still? And why would you put credit into something like that?
And I would continue probably to bang the drum on emerging markets versus developed. One of the earlier panels focused on the return to rationality. We've been through a period of 10 to 15 years of unprecedented levels of cheap credit, and we've returned to rationality of the 30 to 40 years preceding that. There are opportunities for higher returns in that higher risk environment, and Africa is certainly one of those opportunities, and no doubt we'll come on to that later on, given the socio-demographic changes we're seeing in Africa. So I think there are opportunities to drive growth and deliver returns that meet the risk appetites that are out there.
So one of the things we discussed before we came on, and you touched on there, I kind of pick on the return to rationality quote that you just gave me, quite widely spoken about in media at the moment is a kind of disassociation stroke delta between seller and buyer valuation expectations. What do you think is a sensible way to kind of trying to bridge that gap? I think you touched on kind of equity rather than raising debt, that's certainly one way, but maybe pass it back to you to answer that. How do we deal with the delta valuation expectations and return to rationality?
I could probably take this. I mean, we're actively looking at mid-market assets all the time. We've been incredibly busy. I would say those processes that were sort of heavily auctioned 18 months ago, the processes are not as robust as they once were. And in several cases, we're starting to see sort of busted processes where assets are taken off the market altogether because of a mismatch in expectations on valuation, among other things. If you are long cash and you're looking at assets, I think you can either stand your ground and do something, stay rational in the way you look at the valuations. Clearly, you have to use higher discount rates than you did before. Or in some cases, people were talking about earnouts as a way to bridge the gap. There are a few deals where VLNs have been done. Federal long notes, I'm not sure those have been worked out that well in every case, but the processes have drifted sideways, taken a long time, and in some cases ended up with different outcomes than was originally expected. That's for sure.
I mean, on our side, what we do see is actually, a lot of the businesses were built in the past 5 years with a little bit of the VC mentality, in the sense that as long as you were doing things right, you will get that next round of capital coming in, whether on debt or equity side. And that's clearly no longer the case. I mean, simply you need to now plan your deals in a way that you can get to break even on a cash basis, at least, within this current scope of round of financing. I think that's been quite a big challenge. So a lot of these processes that are not succeeding, they're also risking not just the valuation impact, but the actual kind of survival of the company and the asset, which is quite challenging. Yeah. And if we look back 100 years, it's kind of like we make an assumption that because it's infrastructure and everybody needs it, everyone's going to make money as long as we place our chips on it. And I'm sure the people that did railways 150 years ago, probably a lot of them lost money. We do have railways now, but we forget that they probably went bust, got nationalized, and went through a few cycles as well. So I think this one best cure for this bridging that gap is probably a few of these things will go bust, and everybody will learn their lesson and be a bit more reasonable. But I worry that that's going to be the only solution to this.
Simon, you earlier said that you didn't think the UK was overbuilt from a fibre perspective. I think there's obviously a lot of opportunity in the market, a lot of people chasing that kind of fibre build out. How do you think that's influencing kind of appetite for investment in that market? Have you seen other people sharing your opinion?
So there's about 5, 6 in the market right now, probably, that are trying to raise money, and not all of them will succeed. Let's put it that way. Difficult to differentiate them as well, I think, to some extent as well, because everyone's still trying to do the sort of parameters of what really was good 2-3 years ago, how people thought about it. Eventually, it's going to be that these founders or financial investors behind them will have to find a way to sit around the table and figure out how they put these things together with a bit more money to make it work. Unfortunately, it involves people, and that doesn't always work. At least that's what I found. So I think it's going to be a difficult. Somebody with a lot of money and patience could put all these things together, but it's not an easy job. Just look at the cable market and how long that took to consolidate. I think it's going to be a similar kind of process in fiber.
Yeah, if I look to the way we look to the fiber market, is that I think in the beginning, say 3-4 years ago, there were that every transaction was easy to be financed. That were the altnets which were front running. Now we very much look at the marketing capabilities of the management, because indeed we don't want the cables in the ground, but we want people being connected and paying a monthly fee. And I remember actually from say 2 years ago, there were a lot of internal proposals of a company with say 1 million revenue coming up for financing of 500 million, and say, what are we doing? This is really crazy, and you don't see these things anymore. That's really indeed more equity first, and very much focused on cash flow.
So pivoting slightly onto a different subject, and there's very different views globally on the subject of ESG. I think one of the things we're seeing is a significant focus in diligence in deals in relation to all ESG topics, and funds having very specific requirements from their LPs in relation to how they manage diligence and how that's going to be reported through a deal. It's obviously affecting capital allocation and is definitely no longer a tick box exercise. We talked earlier a little bit about some of the different views in different states in the US and globally, but maybe pass to the panel. Welcome anyone to jump in first.
I would say we are in the middle of, at the moment, of the ESG. I think every institution is in the middle of the ESG discussion. If I look the way, first of all, what I find apart, of course, from the ESG, which is very good for the world, what I also find very important is that it's very energizing for your team. Say people find it super important that in my case then the bank is really taking this very serious and doesn't look at it as tick the box, what we have to do for the Dutch Central Bank, etc. But that we really do something, and within the infrastructure team, what we are trying to do is, say first of all, I think digital is already, if you look to cables, if you look to data centers, is a necessary to be able to go into energy transition. But we're also doing energy transition transactions like battery storage, like EV charging, and we really put more targets on that despite of the fact that these transactions maybe have, say, a lower ROE for the bank, we still want to do them.
From our perspective, we've been touched by ESG for quite some time, so we have DFIs that are both shareholders and within our bond, and DFIs have always tended to be more forward-looking in this area. So the due diligence that they carry out is quite rigid in the ESG space, and it's quite helpful when they're an anchor investor and other investors know that they're on board, because it does help to drive further engagement with investors across the board. The elements that I'm seeing is outside not just the DFIs, but more widely, is a greater level of tracking of what we say you'll do by investors, which in the past, your point, it was a tick box exercise, but that really is changing. And on the capital flow side, through the course of 2022 for emerging markets, capital markets were practically closed. There were no sub-Saharan African issuers of debt through the whole of the year. And the one area where we saw capital, and that was because capital were flowing out of emerging market funds, the one area that we saw capital inflows was in ESG. So when we come to refinance, we certainly feel that's an area, a capital pool that's widened our overall investor base, and we will go after. Notwithstanding the fact that there are, it's very early days, but there are some greeniums out there, so discounts to coupon rates, generally because businesses that do follow sustainable business practices perform better, and as a result there are some small discounts that are available. We'll see how that develops. Another thing that we're seeing actually on the sell side is analysts who've previously been emerging market or high yield fixed income analysts have actually wholeheartedly transitioned into ESG analysts, which is a surprising change, but something that we're very cognizant of and trying to keep on top of.
I've always been spoiled by the fact that I was doing mostly fiber, and that was inherently ESG friendly, I suppose. I mean, as a manager, obviously, we spend a lot of time on that, given the energy verticals and transport and other sides. I think on the data center space, it's quite interesting. You still get one of these, Bitcoin-oriented data centers approaching once in a while, and we try and stay very clear of it. But it is an interesting market in the sense that, on the fundraising side, certainly there are certain geographies where ESG is viewed as more of a sort of resource-absorbing and time-absorbing question rather than a necessity. In Europe, obviously, the view is radically different. Again, in a day-to-day activity, from my point of view, we do value it a lot, but in practical terms, I've had projects in the past with the fatality of building fiber, and things like that do make you think about it a bit more carefully and make sure that it's not just about some big global issues, but about organizing things properly on the ground.
So we've touched a little bit on the kind of risk capital appetite for kind of investment, potentially pre-revenue. How are you seeing the market changing towards kind of growth businesses and favouring investment in clear growth rather than kind of build to then sell on, potentially even pre-revenue?
I can start. I mean, it's a perennial chicken and egg, obviously, right? And especially in the larger data center projects that we get approached about. You've got all the hyperscalers ready to commit as soon as you've funded and built it, and they will not commit until you've built it, and you don't want to fund it until they've committed. So it does make the play for us rather more difficult, which is why we try and at least start with a platform that already generates a certain amount of profitability, and let's say bolt-ons which on their own do not completely derail the process if the sales are slower. From my perspective in data centers, it seems like it's a perennially difficult segment to find a combination between people who know how to build and develop them and who know how to fill them up. And even when you find them, getting them into the same room and to agree on something is also not so easy.
Maybe we jump to Mark on that. Do you see a different view in emerging markets?
Yes, so I alluded to the fact that the capital markets have been pretty much closed to emerging market businesses in recent times. And obviously the risk profile has increased as rates have grown up, the risk aversion has increased. But there is, I alluded to it earlier on, a fantastic opportunity in Africa. It should be a driver of global growth in the future. It's a very young, rapidly growing population, increasingly well skilled. 6 of the 12 fastest growing GDP countries in the world are in Africa. We operate in a few of them. The African Continental Free Trade Association is gathering speed and should be established very soon. And that should be a great driver of further collaboration, innovation, investment and trade expansion. So there are great opportunities for growth in Africa, and we're very much at the heart of it. We hope governments continue to double down and aim to drive environments that continue to nurture private sector investment and further growth and innovation. And we want to be very much there as the connectivity partner of choice. We operate in well over 20 sub-Saharan African countries, but in many of them, internet penetration is below 25%. So a serious impediment to social inclusion, digital inclusion, financial inclusion. We have a vision of a digitally connected Africa that leaves no one behind. It's very much at the forefront of how we think the business will progress. And Africa today, capital is much safer than it used to be. It is a very different world today. And the opportunity there isn't for tomorrow or in 5 years. We certainly feel that it's there right now.
No, thank you. I'm told I think we're running out of time. So if there are any questions, does anyone have a burning question that they've managed to think up in the 20 minutes we've been talking? There was a gentleman in the middle, managed to talk loudly.
Oh, I have to check.
I think so.
Yes.
My question is for Mark. Sticking to what you just been describing and going back to your introduction, when you said that Cassava had 3 elements, the renewable energy, data centers, and network. How much have you already been able to leverage the renewable energy business into the other 2 divisions? And what does the future look like in terms of continuing to do that?
Limited so far. It's capital intensive business. We've got fantastic property with lots of ability to put in place solar panels to drive that renewable energy across both our fibre infrastructure and also, more importantly, the data centres, which are obviously very energy intensive. It is very early days. We are hungry for capital, but we recognise that obviously there's a greater level of risk in African businesses. So we've got some grand expansion plans that will follow the expansion of our data centres over the coming years.
Yeah, at Cordiant we actually have an initiative underway with our energy team, who I sit right next to find specific opportunities to develop carbon-free power projects, near or adjacent to data center projects that we're looking at. So we're actually looking at two specific opportunities right now where we can actually sell the power off.
I think actually one of the most between bankers easy ways is to have more data centers in the Nordics, because there and they have already huge access to renewable energy. So I think the most easy way to basically to reduce carbon emissions in, say, countries like the UK, Netherlands, etc., is to have more data centers there.
We saw the highest M&A multiple ever paid for a data center in Norway about a year and a half ago. It was called Green Mountain, and they paid 34 times EBITDA for it, I think, with big expansion plans and growth expectations, but very cheap green power. That was a big driver of that deal.
I think we probably don't have time for another question, and before we open the box back into kind of valuation expectations in relation to 34 times for data center businesses and where the market is at the moment, I'll maybe just say thank you to the panel and thank you to our hosts for having us.